And for more on what Dodd's departure means, especially to the future of financial regulatory reform, we are joined by Scott Talbot, Senior Vice President of Government Affairs at the Financial Services Roundtable. Scott, coming to us from Washington, D.C. Scott, thanks for joining us. Listen, we were talking with Richard Blumenthal earlier today. I was wondering how this will affect the legislation that Chris Dodd has put forward as far as financial regulatory reform. A lot of people saying that it basically enshrines the too-big-to-fail doctrine. But you point out that the Attorney General, if he wins the Senate seat, is not going to really have much influence on this regulation because it'll already have gone through.
Yeah, I mean, Chairman Dodd's announcement today does not affect the regulatory reform bill that's moving through the Senate. He has set up bipartisan teams of senators to work on each title, and we expect some sort of proposal from them by the end of this month, beginning of next month. And this bill will become law during 2010. So by the time Senator Dodd's term is up, the bill will have done and been enacted into law.
All right, so bottom line, in terms of his retirement, no changes at all you see for financial regulatory reform in terms of the proposals that are out there?
No, I think what it does is it doesn't affect the timing, but he will not, Chairman Dodd will not be subject to the political pressures that come with a re-election campaign, as well as the time requirements. And so that will make it easier to craft a bipartisan bill that can move through the Senate. Secondly, to address your point about too big to fail, both the House and the Senate bill do address the concept of too big to fail, which the industry thinks should go away by giving the government the power to divest large institutions.
Well, the House bill doesn't even mention too big to fail, and I think it's 1,300 pages long.
No, the House bill actually has an amendment that would grant the government the power to divest large institutions. It was Mr. Kanjorski's amendment.
All right,
it doesn't say too big to fail specifically, but it gives them that power. That's the effect of it.
Let's talk about the possibility of letting a big bank fail. I mean, don't both pieces of legislation attempt to create funds, super fund of sorts, to save a large institution from failing? And is that even possible?
No, it doesn't create a fund to save an institution from failing. What it does is they create a fund. They both contemplate a fund that if an institution fails, then those private dollars that come from the industry would be used to offset the cost so that the taxpayers wouldn't be on the hook for the cost of that failure.
To help wind it down.
So it's not to prevent a failure. Yeah.
To help wind it down. Is it even possible to create such a fund? I mean, it seems that the costs of a major bank, the cost to wind down, let's say, a major bank would be incredibly high.
Well, first of all, the bills both strengthen the capital requirements and help the companies better manage their risks. So you're going to reduce both their exposure as well as the riskiness and the probability that the company would fail. But if it should, they're talking about a $150 billion fund to cover any losses or any expenses of the wind down process. And that should be more than sufficient with those 1-2 punch to deal with the problem.
Scott, let me ask you about those. Senator Tim Johnson. He's a South Dakota Democrat. He's in line to succeed Chris Dodd as chairman of the Senate Banking Committee. I mean, how do you think he, though, might ultimately put kind of his mark when it comes to kind of reform going forward when it comes to the financial industry?
Well, first of all, he's not chairman yet, and Chairman Dodd still has another year left on his term. But Senator Johnson, as he pointed out, is from South Dakota. He understands a lot of the issues facing the financial services industry, and so he might have a different take, as any other senator would, vis-a-vis Mr. Dodd.
So bottom line, you expect him to be kind of sympathetic, if you will, to the financial industry?
Well, he has shown in the past to be supportive of issues that the industry cares about, such as credit card issues, as well as creating an optional federal insurance charter, which is very important to the industry. And so he is a little bit more pro-reform in a positive sense, rather than instilling some negative regulations that are being proposed elsewhere.
What about Richard Blumenthal? I'm just kind of throwing out some people who obviously will have some say, potentially, in terms of the financial industry going forward. You heard him say, as we began this segment, that he's going to stand strong against special interests. He's against scams. So based on what you know about him and his history, what do you think that could mean potentially for your industry?
Well, it's tough to say, because if he is elected to replace Chairman Dodd, he may not necessarily get a seat on the Senate Banking Committee. So he may not be in a position at that point to have an impact on that legislation. As a senator, if he was a sitting senator, he would obviously have a vote on the floor, and he would be able to vote his conscience that way. But there's so many steps between now and then, it's tough to predict at this point.
He has actually made comments, though, about his take on the credit card legislation that he thinks needs to go through. He's concerned about rates that a lot of people would see as usury. How do you feel about the changes, the regulatory changes coming to the credit card industry? Because it's one area where a populist politician will win a lot of votes by working hard to change things.
Sure. The president has already signed into a law that will reduce the ability of the industry to increase rates on existing credit card balances, and will increase disclosures. And the industry is all for those disclosures. We have some issues with the interest rate changes, however, because credit cards are the riskiest type of loans. There's no collateral there, and the interest rate is driven in large part by the individual borrower's credit history and credit profile, as well as the general economic terms. And so because credit card is such a risky loan, the interest rate should be allowed to float with those general risky conditions.
But you can
so
change.
It makes a challenge. Yeah.
For example, you change somebody's interest rate even if that person is paid on time and hasn't had a devalued credit score.
Right.
There are certain changes that a lot of people don't understand. Why are these made?
Yeah, for those individuals that have a sort of perfect credit score who haven't done anything wrong or anything to trigger an interest rate term, unfortunately, the credit card industry is part of it woven into the interest rate is the general economic risk that we're all facing. And since we're all in this together, that risk can translate into higher interest rates as well as lower credit lines. And we're seeing that across the board.
Hey, net, Scott, let me just go back to, when you got the news about Chris Dodd, I mean, did you guys kind of breathe a sigh of relief here? Not that he's retiring, obviously somebody who's been in Congress for a long time, but maybe potentially what it means for your industry.
Well, I think that our take on it is it'll make it easier to craft a bipartisan reg reform bill. And the industry is for regulatory reform. We need to modernize our regulatory framework. And so by removing him from the political pressures of a re-election, we think it'll actually expedite the process and get a bill through the Senate and to the president and reconciled with the House and to the president sooner. And we think that in the end, that's good news. That's beneficial for the economy and it's beneficial for the sector. And so long as those reforms are done right and they're balanced, we'll strengthen the industry. And we think that's a positive development.
So, Scott, should I take that as a yes?
Take it as a qualified yes.
All right, we're going to run.
I mean, we're not pleased to see him. We're not pleased to see him go, but we think it'll help the process.
Got it. Hey, Scott, thanks so much. Scott Talbot joining us today.